Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have Adrian Day of Adrian Day Asset Management and the portfolio manager of Peter Schiff's Euro-Pacific Gold Fund. Adrian is going to give us his take on the economy, precious metals, commodities, and the questions you submitted. Adrian, thank you for coming on the show.
Well, thank you very much for having me, Steve. I look forward to this. I love the title of your podcast.
Thank you. Thank you. I can't take credit for it. I put it out. One of the listeners put the title and it got the most votes. So that's what we got. I like it too, though. It's a neat theme. Okay, go ahead and just give us a couple minutes on your story, how you got into investing and how that led to your company and the work you do for Peter Schiff.
Oh, okay. Yeah, well, I graduated from the London School of Economics with a degree in history, British history. And if I can do a tangent there, it was a long time after that I got into investing, but a tangent would be that I find many of the best investors, and I'm not talking about myself here, but many of the best investors do not have an MBA, did not study investing at college or business at college, but they come from disciplines that tell you about human nature. So there's psychologists, there's English literature, maybe not a modern US liberal college, but English literature, history. These are things that tell you about human beings and human behavior, and I think that is very, very important when when you're looking at investing. So anyway, I graduated from LSE. I was always interested in politics. I worked for a couple of political organizations in England. One's called Society for Individual Freedom, which I think tells you what it was about. And my interest, I guess partly because I was at London School of Economics, but my interest was always in economics. So I wrote about economics, economic policy, and it's a short, perhaps a short leap from economics to investing. And I joined a firm that wrote newsletters, economic investment newsletters. And after a while, I just started getting so many letters and queries in those days, it was letters, not emails, from people saying, hey, can you help me with this? Can you help do it? And I just decided to set up my own firm, frankly. I had no particular experience other than, 20 years of doing it, writing about it, and so on. I think one of the, if I may, another tangent, but it's a lesson. One of the things that really hit me when I was writing the newsletter, I'm not saying by any means that my advice was always right. It certainly wasn't. But it was very frustrating if I wrote an article saying, this is a great junior gold stock, I think it's going to make a discovery. It's at 20 cents. Buy it up to 24 cents. And people would write to me a year later and say, well, I lost money on that. That wasn't a very good recommendation. I said, how do you lose money on it? I recommended you buy it at 24 and you sell it at 48. Oh, well, yes, but I didn't. Yeah, but, by the time I got around to it, it had already moved up. So I bought it anyway. That kind of thing. And so I think and that leads to one of the best attributes of a successful investor is discipline, and discipline involves missing out on things. I can't tell you how many times I've spent time, hours, days, phone calls, researching something, and by the time I decided I thought it was a good buy, the price just wasn't right. And you have to have the discipline to say, and this applies to all businesses, all sectors, of course. The chef spends time developing or testing different ingredients to see if they'll work together. Well, if they don't work, you don't, the chef doesn't say, well, I've spent 20 hours on this. I'm going to sell it to my customers anyway. You just have to say, didn't work. And the same goes with spending time researching investments. Sometimes your conclusion is it's not a good investment. And sometimes your conclusion is, it would have been a great investment a year ago, but not today. Anyway, that's where I am. And then I had my own firm from 1991, so I've been doing it a long time now. We manage money for individuals. Mostly, they're not, I mean, they're people with money, obviously, but they're not what's regarded these days as high net worth people, which is like, you know, 10 and $20 million. But they're well-off people. And then I've been doing that since 1991, and Peter Schiff asked me to manage his gold fund, which he started in 2013. So I've been doing that, oh gosh, a decade now.
Yeah, 11 years. That's awesome. I haven't heard that one before. So you got a degree in history, and what the story you were telling, what I hear is that basically you were taking your interests and applying them to investing, which is politics and economics, and that translated naturally into starting your own fund.
Sure.
Okay, what is your macro view of the world economy and financial markets today?
Oh, wow. That's a huge question, isn't it? I guess the bottom line would be we're in a heap of trouble. In most places or most economies around the world today, we simply have too much debt. And we have too much debt at the government level, the corporate level, and the household level. And that is a result of the decade or decade plus excessively easy money that we had, not just in the United States, but around the world. And that came, I mean, it really, with Greenspan, it started 40 years ago with the Greenspan put, but it really was exacerbated after the great financial crisis, and we've never looked back from there. And the problem with excessively easy monetary policy, that's QE and its lower interest rates, is of course that it encourages people to take debt, and it encourages people, and I use people in the broadest sense, people to take on debt, and it encourages people to make investment decisions, to make spending decisions that are inappropriate. And so when the music stops, we're left with a lot of what Austrians call malinvestments. We're left with a lot of debt. And that is, to me, the biggest situation in the world today. I don't think inflation, I'm not one of those people that think inflation is going to run away anytime soon, but clearly inflation is very stubborn right now. And as, I don't agree with Milton Friedman on everything, and he doesn't agree with me on everything, but, inflation, you cannot have inflation if you have not had excessive money creation. So excessive money creation doesn't always lead immediately to inflation because there's other conditions. But you don't have inflation, which most people think is the increase in prices across the board in an economy. That's the result of inflation. The definition of inflation used to be excess money creation, but and that's at the base of it. And so you can't have 12 years of excessive money creation, not just in the US, but around the world, and not expect to get higher prices. So I think inflation is stubborn. It's not going to go away anytime soon. And certainly what the Fed has done so far, which is from zero lower bound to 5% or whatever it is, the most aggressive rate hiking cycle in history, in percentage terms, more aggressive than Volcker. Not to take anything away from Volcker, but notwithstanding what they've done, they have not done enough to kill inflation. And that applies in Europe, it applies in Britain, it applies in Canada, many parts of the world. So inflation is going to remain stubborn, and the economies of the world, generally speaking, are slowing, but the slowing is masked to some degree by those 12 years of excessive money creation, which gave people the opportunity. Yes, they borrowed money. Yes, they spent too much money, but it also gave people the opportunity to refinance houses at lower rates. It gave corporations the opportunity to term out their debt. And so we entered this period of rate hiking with, generally speaking, people in a better financial shape than in other rate hiking cycles. And so therefore it takes longer for the effect of those rate hiking cycles to become evident on the economy. But you know, the other thing I think that's important to say is, particularly in the US, is true in Canada, is true in Britain, the increasing wealth disparity is masking a lot of problems. When you look at aggregate statistics in the US, well, the unemployment's low, the GDP is high, consumer spending is strong. You know, all the aggregate numbers look pretty good. But if you lift up under the hood, you find that there's a huge difference in all those areas between 50% of a population and 20% of a population at the high. I'm far from a socialist, so I don't want anyone to get the wrong impression. I have no problem with wealth inequality if the wealth inequality came from hard work. You know, nobody gets upset that Steve Jobs had so much money because he invented something, or he didn't invent it, but he and his friend invented it and he marketed it, and it was a product that people wanted. Nobody has a problem with that. The problem, of course, is when the wealth inequality comes about as a result of government action. And by government action, I, of course, include the Federal Reserve action. And so you look at the US economy right now. I mean, consumer spending might be a good example. Consumer spending on the surface looks good. It keeps going up. Now, two things. One is it's not actually going up quite as fast, as rapidly as inflation is, which means people are spending less in terms of volume. But the other thing, of course, that's important is that 50% of the population is doing their consumer spending by running down their savings and by running up their credit cards. So that's not healthy. And obviously it can't go on forever.
Yeah. Okay. So what I hear you saying is that we're in a heap of trouble. We went through this period for years where money was almost free. And you know, with QE, low interest rates, we basically encouraged this attitude of, you know, picking up a bunch of debt, which caused excess money creation, which led to inflation that we saw over the last couple of years. And it's been stubborn. There's an economic slowdown, and this is probably going to take longer to realize because everyone could see that mortgage rates were 2.5%. So everyone refinanced, you know, kind of kicking the can down just a little bit further. And this is leading to a wider gap between the uber wealthy and the poor.
Yeah. And the longer rates stay where they are, you know, the higher for longer mantra, the longer they stay where they are, then more people and more corporations start to come into the, start to be affected by the higher rates. So, I mean, just an example, the person, for example, the house bought a used car 5 years ago. And I don't know what you would have paid for a used car when interest rates were 0.25%, probably, I don't know, LIBOR +4, I don't know, LIBOR +5. So you'd have paid 4 or 5% on your used car. the used car is just about ready to go to the junk heap, right? But between 2018 and 2024, that family had a car. There was no problem. They had the car. Now they have to replace the car. Well, they're not paying 4 or 5% anymore for a used car. Again, I'm sorry, I don't know what those rates are, but I
I
can
don't
tell
know,
you,
but they got to be at least double.
well, if it's LIBOR plus 4, you know, we're going to be looking at 8 or 9%.
Yeah.
And that family may well have been able to afford the 4 or 5% 5 years ago, but maybe they can't afford the 8 or 9%, especially when costs have gone up, you know, prices have gone up in the meantime. And so the point I'm making is that the household that sort of were okay for 5 years, suddenly, they're not all right. And it's the same with corporations. A corporation that turned out their debt 5 years ago and it all comes due in 2025, other than, or their earliest debt comes due in 2025, other than general effects on their consumers and demand for their product, they haven't been affected by higher rates. But next year, when half their debt needs to be rolled over, and it needs to be rolled over again at much higher rates than they had originally, then suddenly that corporation, that business gets into the red zone, if you want. And so that's why this higher for longer, it sort of starts to affect more and more and more of the economy as time goes on.
Yeah. Now, okay, getting into your expertise, one of the best hedges of that. What is your current outlook for the gold market and gold miners?
Yeah. If we may, we just need to just remind people, everybody knows this, but just stand back and remind people, gold has been going up for 18 months now, and it's been going up until recently, really until this year. It's been going up almost exclusively because of central bank buying. Then at the beginning of this year, particularly in February, March, we had a lot of demand from Chinese consumers. And these were generally savers who wanted to protect their purchasing power because of the slowing Chinese economy, because of the threat of a yuan devaluation and rumors that there was going to be, you know, stimulus. They don't want to put their money in the banks because the banks aren't very stable. They certainly don't want to buy real estate for obvious reasons. Until recently, they didn't want to buy stocks because stocks just in China, Chinese stocks just kept going down every single day. They're not allowed to buy crypto. And so gold was the only hedge they had. So you had central banks all of the last 18 months. This year, you've had Chinese buyers, number 2. But those numbers combined do not add up to all of the buying that we're seeing in physical gold. But if you look at the ETFs, other than the Asian ETFs, we've had outflows from ETFs, right? So the retail buyer in the US, and even the small institutions that use the ETFs like GLD for buying gold, for exposure to gold, they haven't been buying. And you look at coin sales, you look at deliveries from the mint, you look at coin premiums, they're all way down. And that's a reflection of a lack of demand for physical buying, and that's retail. So there's something else going on in the gold market, and I think that is, and there's evidence for this, very large buyers, mostly in the Middle East and Asia, but also in the US, who want to hedge, who want to take a hedge, and they're doing it by buying either physical gold. And if they're buying physical gold, they're doing it over the counter so that, I don't mean they're doing it so that the numbers aren't reported, but they're buying over the counter, which means it is not reported. And again, if you look at the GLD, which is, you know, the largest gold ETF in the US, you're continuing to see, you've seen a bit of a change, but you're continuing to see outflows. I just looked before we started the last 8 days. 4 of them were inflows and 4 of them were outflows. So there's no massive surge of interest among ordinary investors in the US into gold. Now, everybody knows that up until recently, the gold stocks had lagged, right? And the gold stocks had lagged because the buyers, central banks and Chinese people, who are the main buyers, they're not going to buy US or North American gold stocks. They're going to buy physical gold. And that's why there was this huge disconnect between physical gold and gold stocks. Obviously, in the last, 6 months or since the end of February, the gold stocks have caught up and overtaken gold in terms of performance. And yet, you look at the GDX, let me, let me, so even though the gold stocks are going up, ordinary investors and institutions are still not flooding into gold stocks. And the evidence of that would be, for example, the GDX. Astonishingly, since April the 3rd, there have only been 2 days of inflows into the GDX.
Wow.
And they've both, and now that's up until, that's up until the 17th, which is the last numbers reported by Vanguard, whose fund it is. And both of those 2 days were the 2 most recent reported days. But nonetheless, you've had a period when the gold stocks have gone up 30% and there are net outflows from the GDX. And if you look at funds, I'm not supposed to say, about our fund, but if you look at the mutual funds in the US, and I've talked to a lot of fund managers, they are all reporting the same thing, which is January, February was consistent and steady outflows. March, a little bit of an inflow, and April and May, you're seeing basically as many days outflows as you're seeing inflows. So it's been a little bit of a change, but very, very, I would say, slow. So again, no dramatic surge into gold stocks. Now, what that tells me is that the buying for gold stocks is coming from large, it's coming from 3 sources, I think. It's coming from hedge funds. Hedge funds have picked up their buying of gold stocks. It's coming from large investors who are concerned about the financial system, concerned about the stock market, and want that hedge. And so you've seen people like Druckenmiller take very large positions in a handful of gold stocks. And you've seen several examples of that. Michael Barry, of course, bought gold famously last week. He reported it last week. But there's still been no surge from ordinary investors or even from the broad swath of institutions. As a contrarian, what that's telling me is extremely positive. Because if you can have gold stocks go up 30% in 2.5 months, when there are net outflows from the GDX, just think what's going to happen when ordinary investors decide they want to buy some gold stocks. So that's a long-winded answer. I'm really sorry. All my answers have been long-winded today for some reason. And so where are we? Well, there's reasons ordinary investors are not buying gold and are not buying gold stocks. The macroeconomic environment, if you just took a snapshot, high dollar, high interest rates, strong economy, presumably, or as it would appear, and a strong stock market. Well, in that environment, you don't want gold. And you don't want gold stocks. And so people have not been rushing into it. When those things start to change, when the Federal Reserve does start to ease, and I think they'll ease in several ways before they cut rates, but when they start to ease and eventually cut rates, when the stock market starts to wobble, particularly the leaders of the excuse me, for leaders of the bull market for the last, few years. When they start to wobble, we don't have to have a market crash, but just they're not as strong as they were. When the economy starts to slow, when the dollar starts to go down, then that's when people, the massive investors, will turn to gold. So that's number one. And number two is we are in a remarkable situation right now, Steve. And I have to say this. Normally, you look back to 1976, you look back to 2000, you look back to 2009. In all those instances, the gold stocks took off, like a rocket. And people, most investors were scrambling to catch up. So you look at 2009, for example, the gold stocks have gone up 50% in about 2 weeks, and they more or less, they went up about 70% in a month. That was before gold had even gone up 20%. So, and the same for 2001 from the bottom. The gold stocks moved very, very dramatically before gold really had moved much at all. What we're seeing this time is completely different. Gold, of course, has gone up, from whatever, 1800 to 24 and a half in the last couple of years. And the gold stocks have only just begun to move. And they are, despite the big run we've just had, they are still, in terms of price, they are, by and large, they are still lower than they were a year and 2 years ago. And in terms of valuation, they are just incredibly low. So just to give an example, which I've given many times, but Agnico Eagle, which is the top number 3 gold mining stock in the world, gold mining company in the world. And I mention Agnico because it's a nice, clean company. It's all in good jurisdictions. It's got a good balance sheet. There's no particular major problem with it. And so people can't make an excuse. When I talk about Barrick, they say, oh, well, that's because it's in Pakistan. That's why it's so cheap. But look at Agnico. There's no excuse. There's no hairs on that dog, as they say. And yet is selling at more or less its lowest price to free cash flow multiple in 40 years.
Wow.
Now, when gold is where it is today, that simply does not make sense. And in the first quarter, you saw Agnico, along with many other companies, really knocked it out of the park in terms of earnings, because, of course, the price of gold had gone up. But let's not forget, the price of gold only moved in March. If you look at January and February, gold was strong, it was doing well, but it really only began to move in March. So if you look where we are right now, the gold price today is $250 higher than what the companies were selling their gold for in the first quarter. So if the first quarter earnings were strong, the second quarter are going to be incredibly strong.
Yeah.
And so the conclusion, sorry, if anyone's still with me, the conclusion is that we are in a remarkably lucky and opportunistic phase right now, where gold has gone up, but the stocks are lagged and the stocks are still very, very cheap. So people have a wonderful opportunity to buy the gold stocks now.
Well, that's good to hear as gold bugs. So I hear you saying that back when everyone was talking about central banks are buying record amounts of gold, we're pulling up charts that are showing exactly that. That kind of led the charge from, I think the triple bottom was 1615 to the rise up. When 2024 came around at the beginning of the year, February, March, there was a lot of buying by Chinese retail that kind of propped it up a little bit more. But we still haven't really seen USA retail buyers coming in. You hear little stories about Costco selling gold and things like that, but we haven't really seen any herd movement yet in the US. But you've got evidence that hedge funds are starting to get into this. Michael Burry, Druckenmiller, are starting to buy in, and even though we've had what's been an amazing move in some of these, you mentioned Ignico Eagle, I think it's up 40 or 50% from the bottom.
Yeah.
And you're saying that even though the chart looks like it's just climbing, that when you look at the valuation, those are still cheap.
Yeah, because we had such an increase in cash flow in the first quarter over last year. So then the valuations, if the stock price goes up 30%, but your cash flow has gone up 30%, your valuation hasn't moved much.
Yeah, yeah. But what's really nice about these miners is they're so leveraged. Let's say they were profiting $200 an ounce at 2000 gold. Now we're at 24.50. You know, their income went up 400. So they're doubling and then doubling again, right?
Right, and they're beginning to get the cost pressures are beginning to ease a bit. Now that's not going to stay forever. I'm not, but right now we're at a situation where the costs of mining have not moved up. You know, we had the big moves last year, beginning of last year and the end of 2022, but the cost pressures are kind of under control now. So you look at oil, for example, it's less than $90 a barrel. Oil energy is the number one cost input of running a mine, not building a mine, but running a mine. Back in 2011, when gold was at last at $2,000, oil was $140, $145 a barrel. So we haven't seen the sort of cost pressures that we saw last time gold moved up. They will come, and that's why I say this is just a remarkably fortuitous period.
Yeah, where they haven't caught up to gold yet, and energy prices are cheap, which is probably not going to be the case going forward. Um,
Correct.
okay, Rafi wants to know, Adrian, thank you for the opportunity. When do you think the precious metals price will mature, and how do we know that it's time to start taking profits?
Well, that's an excellent question, and it's good to start thinking about that in advance. One of the things I do, particularly when I buy a certain stock, I always make notes to myself. I write down why I'm buying, what I'm looking for, and what will make me change my mind, what will make me want to sell. And it's a good discipline because you do that before you get caught up in the euphoria or whatever it is. We are a long, long way from the market maturing. I think when it comes to gold, this is a little more difficult, but it's mostly anecdotal, frankly. Unless you start to see central banks hiking rates aggressively, which we're not at that, we've passed that phase. But unless we come to a phase where the central banks are starting to hike rates meaningfully, and the US is getting their fiscal deficit under control. So unless you have macro changes like that, which again, I don't see that coming anytime soon. It's largely anecdotal, by which I mean everybody's talking about it. And you're getting big jumps in price every day, and people begin to expect those jumps in price. You're seeing it on CNBC, the lead story is what gold is doing. And, those sort of things, indicators are good to listen to. You think back in 2001, every time you went to get a cup of coffee, the barista had the latest .com stock to tell you about. That's nothing against baristas, but that's a dangerous sign. You think in 2007, every dinner party you went to, everybody just talked about what their house is now worth and what their second house is now worth, and and people who shouldn't have been doing it were buying 2 and 3 houses. That's a dangerous sign. So when we see that in the gold market, that'll be time to at least start to lighten up.
Okay, I get this question a lot, and I jokingly say when you see on the news that they balance the budget, then it's
Yeah,
time to
well,
sell your gold stocks.
that's why you smiled when I talked about fiscal. Yeah, that's not going to happen anytime soon.
Yeah, when you see kiosks in the mall that are selling gold, then you know it's time. Okay, company questions from Will. A couple of royalty questions. He says, "What do you think of Orogen Royalties? Is it likely to get acquired by a bigger royalty company soon?"
Well, I think people know what I think about it. I think it's a great company. For those who don't know, Origin is a small company. It's what's called a royalty generation company. So they generate projects, and when they bring in a partner, typically they sell the whole project, the whole property, 100% in exchange for a royalty, as opposed to the typical prospect generator model where they'll keep 40%, 50%, 30%, whatever, of the project. So they get rid of the whole 100%, but keep the royalty. But the big news with Origin is they have a 1% royalty on a new discovery by Anglo Gold in southern Nevada called the Silicon Merlin. Silicon Merlin, Anglo came out in February, said it had 13.2 million ounces, which was significantly more than people had been, than Anglo itself had last been guiding to. And then in last month, they came out with a technical study on the Merlin deposit where they had compressed the mining, didn't expand the resources, but compressed the mining, 2 years of pre-strip, and then basically all your mining came in 4 or 5 years. 1 year, they're projecting actually 1.8 million ounces of production, which is just a staggering amount of production. Now, excuse me. Anyway, the point is this is an incredible discovery, and every time Anglo Gold opens its mouth, it's got bigger. Right now, on our last conference call, they're talking about exploration to the west as being successful. And then in their 20th filing, they said that they had drilled just to the north of the deposit for water, a water hole, looking for water, and had found gold mineralization.
Well, that's
so
good.
the thing is just getting bigger and bigger. So I think Origin, despite the big move that the stock has had, remains fundamentally undervalued because it is undervaluing this asset. And Origin, I'll just say, one is they have a very strong balance sheet, $18.5 million cash, which for a prospect for their business model is more cash than they'll ever need. And then they also have positive cash flow. This is a junior company with free cash flow. Have you ever heard of such a thing? They do exist.
No.
But Silicon, the royalty on Silicon Merlin is obviously what's made the stock go up, and what prompts the question. So do I think someone's going to buy it? It's a really interesting question, because if you had asked me 3 months ago, 6 months ago, I said, well, yes, of course, someone's going to buy it because this is a good royalty on a project in a good jurisdiction with a good partner. Of course they're going to buy it. The problem now is that it's continuing to grow so dramatically that an acquirer will pay, typically, if you look at Franco or Wheaton, they'll pay a fair price for what they know, whereas Origin can see all this potential that they actually want to get paid for. And I'm speaking for myself, not for Origin, obviously. So I think there might be a little bit of a mismatch between what a company is willing to pay and what Origin thinks is worth. I think ultimately there's another consideration here, which is that Altius, which also has a royalty on the same project, they have a 1.5% royalty on the project. They're also the largest shareholder in of Origin. They own about a little over 18% of the company. And Euro Pacific, we own in the fund, we own about 7%. And my asset management, we also own shares. So if you look at the largest institutions who are very strong long-term holders, and you look at the insiders, you're basically a 40%, meaning no one's going to be able to steal that asset.
Yeah.
So that was a long way of answering the question. But right now, frankly, it's unclear that someone would be prepared to pay what Orogen and Altius for their royalty think the royalties are worth.
That's a really good so prospect a royalty generator. They basically sell the property, keep the royalty. And I started following this. I think it was 9 million ounces, and then they came out with the news release after the it was 13.2. I'm like, wow, that was.
And that was what, last August? It wasn't a long, or it was a year ago, basically.
Yeah.
So that just shows you how dramatically it's grown. And I just did a sum of the parts over the weekend, just looking at what we know now. Forget the western extension, forget the deep, because they haven't even drilled into the sulfides yet. And in that part of Nevada, there should be sulfides. Forget the stuff to the north, forget all of that. Just look at what they've got right now. I think that royalty is probably, I added up what that royalty is worth right now at today's gold price, discounted, net present value, just a 5% discount, not high. I looked at what I think Ermitaño is worth, the cash flowing royalty they have, add on the cash that they have, and I just gave them $5 million for the rest of the business, which I think is very, very conservative. You come to a stock price of about $1.90, and right now it's at $1.10. So you've still got plenty of upside, even if the resource doesn't grow any bigger.
Which it probably will.
Which I think it, yeah. This is not blue sky. This is Alberto Calderon, the CEO of Alberto Calderon, the CEO of Anglo, made a really interesting comment on the conference call in answer to a Q&A. He said, we at this company, we don't like to say things unless we've done the work to substantiate them. And this is a very huge deposit that's just going to get, he didn't say huger, he said bigger. But yeah. And when the CEO of one of the largest gold mining companies in the world talks like that, it's different from when, Consolidated Moose Pasture CEO talks like that. This is real potential. It's not blue sky we're talking about.
Yeah. Okay. Let's move on to silver. I'm going to share my screen here real quick and just pull up the silver chart. We've had an incredible move here in the last couple of days, and it's just. This is the daily chart, just from 30 bucks, tapped on 11 or 12-year high around almost 33, and then kind of come down to settle. What's your macro view of silver and the silver miners right now?
Yeah, we all know the silver tends to have these shorter, sharper, but shorter as well as sharper moves than gold. And so, once the move gets going, it can go very, very dramatically over a short period of time. So, it could easily get to, it could easily get to $50 on this move, which will be astonishing because the last time we were at 50, there was a short squeeze, if you remember, and the Hunt brothers were buying everything up. So a different scenario. The silver miners, if I may, the problem with silver, everybody focuses on the changes we've got in the demand for silver over the last 20 years, less photography, now more solar panels, the fact that silver is more industrial compared to gold and all that sort of stuff. And that's all important, but there's also very important differences in the supply of silver. Differences from gold, and frankly, differences from how silver was, 40 or 50 years ago. Right now, we're in a situation where you have when I say very little, let's say 20% of the world's silver production is primary silver production. The rest of it is all byproduct. Now, some of that byproduct is byproduct of gold mines. So gold and silver, they go together. They're both monetary metals. That's okay. But an awful lot of the silver, most of it, in fact, is byproduct of base metal mines. Some of it is copper, but a lot of it is lead mines, zinc mines. Well, the point about that is important. The point about that is that the zinc miner in Peru or the lead miner in Bolivia, who's got 10% of his production is byproduct silver, he doesn't increase his production of zinc or lead just because the price of silver is going up. He doesn't build a new lead mine because the price of silver went up. It's just business as usual for him. And so silver production, silver supply does not respond very well to increases in the price of gold, increases in the price of silver. And that's why even over the longer period, you can have these sharp moves in the price of silver because there is no supply to bring it down. You know, the old saying, the solution to high prices is high prices. But that doesn't work in silver because of most of it is byproduct. Now, that also translates over to the companies. You look at most of the silver companies like Fortuna Silver, what, 12% of their production is silver last quarter. Pan American Silver, I shouldn't say the number, but it's well, because I can't remember, it's well under 50%. I think it's around 30%.
That sounds about right. I was going to say.
And they've got over 50% from gold. So most of the, quote, silver companies, silver miners, have a minority, and in some cases, a significant minority, I mean, a very small minority of their production comes from silver. And yet, when the price of silver moves, everybody looks up the list of silver companies, or they go to their broker and they say, hey, I want a silver company, give me one. And it's Pan American Silver or Fortuna Silver or Coeur d'Alene Silver or Hecla Silver, et cetera, et cetera, et cetera. And so those companies, and I'm not saying I like or don't like any of them, I do like some and I don't like others, but those companies get the bid when the price of silver goes up. And there's very few companies, relatively, outside of Mexican companies and Bolivian companies and Russian companies, there's very few companies that actually have a majority of their revenue from silver. First Majestic obviously is one. And that's why that responds. It always responds when the price of silver moves up. So I would prefer, frankly, to look at companies that I like anyway, because the problem with a silver move like this is it can end as quickly as it started. And, you know, we don't really know when it's going to end. I think it's got legs, but it can end quickly and dramatically. So I don't want to be stuck with the most leveraged silver miner when it starts to come down. But if you look at a company like Fortuna, I mentioned, which has, you know, 55%, I think, of its revenue, 60% of its revenue from silver, very, very strong company, still very reasonable value. Or a company like Pan American, which has, you know, two large deposits that they have potential. One is La Colorada Skarn, which are actually you know, which are in development of, and the other one, of course, is the Escobal in Guatemala, which is the mine is suspended right now. But if they get the permit to restart that, that more than doubles their silver production, and that would have a fairly quick startup phase. I mean, a matter of months, not a matter of years. And I think there's a real possibility that they will get the permit to restart that mine. So you're looking at companies that are good companies, that are solid companies, well-diversified companies, and also have, you know, real upside, genuine upside, other than the silver price. You know, I prefer to look at companies like that myself.
Okay. All right. So macro, silver is only about 20% of silver comes from those majority type mines. The other 80% are byproducts of commodities that really don't have anything to do with precious metals, like you mentioned, zinc and lead. And they're, if they're pulling 8 or 12% of their stockpile is coming from silver, they're not going to all of a sudden mine more cheap lead to somehow, arbitrage that. So the silver price is a unique commodity because it's not necessarily dependent. It's not like these mines are going to ramp up. These 80% of these are going to ramp up to try to make some money at that time. It's pretty much this is the supply that's coming out every year, and whatever the market decides, that's the price. So you have these violent moves in silver that are kind of unique.
Right, right. But
Okay.
it's a great way for speculators and investors to take advantage of.
Yeah, it's been a lot of fun.
Yeah.
It's been a lot of fun. Okay, so that's silver. You mentioned briefly, so it's pretty tough to invest in silver without going somehow into Mexico. What are your thoughts right now on the political? CJ wants to know, what are your open pit mining possibly being banned by could be the future president? Any thoughts on that?
Yeah, I don't pretend to be an expert. Yeah, I obviously have talked to a lot of people who work in Mexico. I don't pretend to be an expert on the situation myself. Everybody is expecting that the new government, even if it comes from the existing party, which is a high possibility, a probability, but everyone's expecting a new government will ease the rules that were put in to some extent or another. And obviously, when a new government comes in, most of the people, just as in the US, you've got political appointees, you've got a political appointee running the environmental ministry, and she's a woman that's been causing a lot of the problems for a lot of the companies, the specific problems for companies. And so those people will be replaced, and everybody is hopeful, but even if you don't have the opposition come in, that you'll get an easing of the rules. I don't think we're going to get a ban on open pit mining. We might get, I suspect we'll get continued examination, scrutiny of new open pit mining, but I don't think they're going to ban mines that already are in existence. That's my thinking. So, for the person that actually, and the other thing is a lot of these cases have been taken to court, and in virtually every single one, but courts have overruled the environmental ministry rulings in favor of the company. Fortuna is a good example of that, of course. We won't go into all that, but for people who know the story, that's a good example because they've won in court 3 times now. So I think for people who know the country well, I'm talking about companies who know the country well, probably a good time, to make some joint ventures on land that's already been permitted. So you can drill, you can explore, because you'll get those joint ventures quite inexpensively right now. Because as you know, most of the major companies have turned their backs on Mexico. If they're not already there, like Agnico, companies that had no projects were just exploring. They've all left.
Okay, so you don't think there's going to be like a ban or anything? As much
I
money as
don't
comes
think
out
so.
of
I
that.
mean, obviously we'll know more when a new government comes in. The election is what, June, I think, or
I'm not sure. I think that sounds
something.
about right.
But it'll be a few months before we see what this government's doing, who they appoint, what announcements they make. But yeah, no, I would be fairly optimistic about that.
Okay, okay.
Cautiously
So with
optimistic.
a focus on ones that have already kind of established themselves with permits, and if you're looking for ones that are going down there and they don't, they haven't gotten started, then you'd be a
No,
little more wary.
absolutely. No, absolutely. That's a critical point. Yeah.
Okay, okay. All righty, that makes sense. Okay, copper. Matt wants to know, I suppose this could go under gold too, but they just have such a massive copper. Seabridge Gold. Any thoughts on Seabridge?
Um, I'm not a fan of the ounces in the ground kind of plays. You know, a lot of people like these massive deposits that have difficulty getting permitted or difficulty, and I'm not talking about Seabridge now, difficulty getting permitted or difficulty raising money or whatever the issue is, but they do have the ounces in the ground. I'm not a huge fan of that kind of investment or speculation, frankly. Now, you know, but they do tend to be sensitive to the price of gold. And of course, there's a whole spectrum of them, you know, from ones that everybody thinks will never get a permit to ones that, you know, they will eventually, but it's just going to cost a lot of money to build the thing, which I guess Seabridge goes into that camp because they've got the permits, but it's just a very expensive project. You know, Seabridge, I'll be honest, I mean, I like Rudy Funk a lot. He's a very smart guy. Yeah, very smart guy. But Seabridge to me, and a lot of companies like that, I use as trading vehicles rather than buy and hold vehicles because they tend to be very sensitive to the price of gold.
Yeah, yeah, they're pretty volatile, and they. I remember when I first started following it, it went from $10 a share to 16 in the matter of a
Yeah,
couple of
and
months.
very quickly. So, and if you do that 2 or 3 times, you can make some money.
Yeah, yeah. I call it the Charlie Brown shirt pattern. When it goes like that, those are some of my favorite, like the SILJs, and those are fun. Okay, Trev wants to know, I put this under miscellaneous. What are your thoughts on the current and future cobalt market?
Yeah, okay. So I don't pretend to be an expert on cobalt. And of course, cobalt is primarily a byproduct, and in many cases, a very small byproduct of, you know, very large mines, primarily copper mines. I prefer, if I may, I'm not an expert on cobalt, let me just switch to a broader comment. In many of these sort of smaller metals, metals that are necessarily byproduct or normally byproduct, or rare earth metals or battery metals, where the technology can change. I prefer to get my exposure through other companies that I like anyway. So it might be a company, you know, a big a big copper miner, but I like anyway for the copper, but I'm getting some cobalt. It might be an exploration company where I just like what they're doing. I like the, you know, the business model and everything else, but they have some cobalt properties that they're exploring for. I like that much better than the sort of 100% bets, and that goes for lithium. You know, I've done quite well on lithium, but I've done well on lithium through Land and through Altius and through Midland. The stock price is down at the moment, but companies that I'm buying for things other than their lithium.
Okay, okay. So you're kind of picking up bets like this in, you know, companies like the ones you mentioned, BHP, Rio Tinto, that they have a little subset where they do pull these out of the ground, but it's in a commodity that you follow a lot more, and that's their main thing, and you believe that's going to do well. So this will kind of be
Sure.
it.
And I like the company anyway.
Yeah,
Yeah.
yeah. Okay. Two questions on basically agriculture. So from Armin and Leo. Just curious to know Adrian's opinion on broad agricultural commodities prospects. And then Armin says he's heard you talk about Gladstone. Does he have opinion on Gladstone? That's the LAND ticker.
Oh, Gladstone Land. Yeah, yeah. Okay, well, first of all, just broadly speaking, I mean, you've got the issue of more people and less arable land and less water. But on the other hand of that, on the other side of that, of course, you've got improved farming techniques, and mechanization and fertilizers that increase the yields. But I think one of the problems with investing in agriculture generally, of course, is that you're very weather dependent. And so you can go from bumper crops to, crop failures from year to year. And I think if you're not well, even if you are a farmer, you still don't know what the weather's going to be like. So that's one problem. And then the second problem, of course, is, well, what do you invest in? If you want to, take exposure, but take advantage of the grains, or the cattle, well, what do you invest in? Because when you think about most of the companies are consumers of the products, right? So you look at cocoa, well, you don't go out and buy a chocolate company because the cocoa price is going up, because they're the consumer of the product. And so that's the other difficulty. I bought one of my favorite companies for exposure to agriculture would be Altius. And again, Altius is a royalty company. It's exposed to a broad range of commodities, including the Anglo Gold's discovery that we just talked about. Up until a year ago, they didn't have any gold, but they had exposure to everything except gold. But they've got copper and nickel and so on, uranium, coal even, although that's they finished the coal now. But they also have exposure to phosphate. So and if you think that the agriculture industry generally is going to do well over the next 5 or 10 years, then phosphate is also going to do
because of the fertilizer.
Yeah. So, that's where I prefer to get my my exposure. And then I mentioned cocoa. So when the price of cocoa shoots up the way it did, it's not going to stay there. And so after it's already moved up, I start to buy chocolate companies like Nestle, which we've had for a long time, but also like Barry Callebaut, which is a Swiss, the largest chocolate consumer in the world. And they make chocolate, they buy cocoa beans and they make chocolate for all sorts of different avenues, from chocolate manufacturers to restaurants and so on and so forth. And so the idea there is you take you're buying into the consumer of a product after the price has already moved up, price comes down and it helps that company. Gladstone Land, So David Gladstone, I've known David probably since 1980. I've known David a long time because we both used to live in he still does live in the Washington area. I don't anymore, but I've been over to his house and so on. Very smart guy, very ethical guy. I like what he does, and he has several funds. He has a Gladstone Investment, a Gladstone Capital, Gladstone Commercial, which is real estate, and then the Gladstone Land, which a person is asking about. No, I think Gladstone Land is going to do very, very well. He's focused primarily on the perennials. So a lot of berries, a lot of nuts, not the kind of agriculture like the grains that can go from glut to drought very quickly. And his business model is a good one, where he buys the farm and leases it back to the farmers. So he's not trying to actually run the farm because they don't have that expertise, but he'll buy the land and then lease it back, to the farmers. I think it's doing very, very well. It's got a nice dividend. The dividend is has been growing. And it's at a good price right now, I would say. It's about 13, don't quote me, it's around $13 right now. I think it's a good price.
All right. So as a general investment theme in this is basically we have more and more people coming into the world every single day. I think the last I saw was at a clip of about 200,000 a day. So there's less land and less water. So investing in something like that makes sense. You could play it by investing in companies like Altius, maybe something like Nutrien, basically playing the fertilizer of that. If we're going to need more food, the easy way to do that is for fertilizer. And
Right.
you mentioned an investment strategy I hadn't thought of is like, I saw the cocoa run up price and I'm like, well, I missed that bet. But that's interesting that you added to your Nestle position because, you know, that spike's not going to last forever and it's going to correct itself. And when it does, you can kind of capture that when they get the cheap product again.
Sure. Sure.
Yeah. Maybe I wonder. I'm going to correlate this afterwards. Remember when the coffee futures jumped up because of the whole thing in Brazil? Like, was
Right.
there companies that maybe Starbucks is the only one I can think of at the
Well,
moment?
Nestle would be another good example, obviously,
Oh,
because they're a huge global coffee
oh yeah,
consumer.
yeah. Okay, interesting, interesting. Okay, I like that. I like that. Well, thank you very much, Adrian. This was a lot of fun. If someone wanted to get in touch with you, what is the best way to do that?
Yeah, the best way to look is adrianday.com. We got, information on the money management, the newsletter. We got different interviews from some of your competitors, sorry. And if anyone had a question that wasn't answered or think of afterwards, just email me and I'll be happy to answer if I can.
Okay, what's your email?
Asset management at adrianday.com.
Okay, we'll put links to your website
Yeah.
and your email down below.
Or through the website if they want, yeah.
Okay, awesome. Well, thank you very much, Adrian. This was a real pleasure. Thank you for coming on the show, and you have a great rest of the day.
Well, thank you so much. I appreciate it. Yeah, thank you.
Yes, and thank you for tuning in. Support the show and hit the like and subscribe and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.